All right. So going back, last time we wrapped up the unit on chart anatomy with advanced wave analysis. We talked about wavelength. We talked about angle and steepness, and also many other factors that can help us understand the chart as a whole. Today, as you can see on the screen, we're going to start learning chart patterns. But as we said many times before, that it is worth it, like not to memorize patterns, but rather thinking about it in a psychology kind of way. But we do have to know like 3 or 4 most important chart patterns that are very easily identifiable and most accurate during stock exchange, and that will really help work. And definitely in the process of learning, we can also incorporate like the conflict between the buyers and sellers and how we can look at it through a psychological way. So let's get started. So most important chart patterns. In the following chart patterns that we will be learning, these are classical chart patterns. They will be based on the analytical tools that we have already learned and already covered. And we will apply knowledge such as price waves, trends, and price analysis onto any charts. So we'll be connecting back to everything that we've learned before. So there are 5 most important chart patterns that we're going to cover. So the first one is head and shoulders, second cup and handle, and then ascending triangle, and then wedges, and then double and triple top. So some of you probably have heard it before if you were engaged in the stock trading community or Discord. These are very, very helpful chart patterns. And we're going to spend the entire class today only on the first chart pattern, because this one has many components to it that will take a long time to cover. And then these will be relatively faster. And since we have the previous knowledge built on the first one, we can move a lot faster with the next 4. All right, so head and shoulders formation. The head and shoulders formation is an ideal introduction, since what it communicates about the market activity and the balance between the buyers and sellers is very, very clear, even without knowing the chart knowledge. So if we didn't even know anything about chart patterns, right? We know that this is going up and this is going down. The buyers are winning and the sellers are winning on that. So the head and shoulders, also HAS, it's best sought during a established trend. It best develops during a already established trend and usually indicates a trend reversal scenario. So as you can see, this is a head and shoulders. This is a head and shoulders, and it's occurring during a already established uptrend, and this indicates a trend reversal. So right here, as you can see, it's labeled the left shoulder, head, and right shoulder, as if it's like the shoulder, head, shoulder, right? So the price waves at the left shoulder and then at the head confirm the conventional trend structure, since they form higher highs and then higher highs, right? This is a higher high because it's higher than the previous one. This is what we talked about last time. These are called price wave points. So higher highs. And then the right shoulder is the first lower high, which indicates that the buyers are no longer as strong as before. So let me draw. So I think if you guys came to our previous classes, this can be very clear to you. This is a higher high, and this will be the first lower high. And then lower high followed by a lower lower low. This confirms a trend reversal. So if we connect the low of the correction waves, we will get so-called a neckline. So let's think about these as body parts, right? This is the shoulder, head, shoulder, and this will be your neckline, like your neck that's connecting everything. So a break of this neckline after the right shoulder confirm that the price is now first lower point and thus signal the end of the upward trend. And now the head and shoulder formation reigns in the new downward trend, which breaks the neckline. So you have a neckline, right? Right here will be a neckline. A neckline is drawn at the beginning, which taking these 4 lower points, connecting them. So if this point goes below the neckline, that indicates the trend reversal, another confirmation of the trend reversal. So it is important to wait for the confirmed breakout to avoid false signals. So for example, if right now, if the stock market is going up, down, up, down, up, down, but it hasn't go below this line, you don't want to enter just yet because it's not confirmed. The specific trend is not confirmed, and we don't want to risk this money if it's a lot that you're investing. So it can be often observed that the neckline is tested several times and rejections occurred repeatedly at this neckline. So the battles between the buyers and sellers is intense at these points, and many traders use the price levels to execute trade or place their trade orders. So now we're really getting into placing trade orders and making actual decisions, right? So what we're talking about is right here. There are so many rejections and fluctuations occurred above this line. This indicates a fluctuation, the strong battle. But then once it go below, it signals a very downward trend. So this image on the screen basically is a very, very classic head and shoulder pattern, head and shoulder pattern at the end of the upward trend, and then the trend reversal of the previous trend. Okay, so that is the head and shoulder pattern at a brief. All right, so let's go to the next slide. Okay, variations in the head and shoulder formation. So to move away from stereotypical thinking, it's worth considering few variations about this head and shoulder formation, and also by variation, the trend analysis. For example, if we were to go back to the previous slide, not every single head and shoulders is gonna look exactly perfect like this. It's not gonna look like this, right? Perfectly lined up with a neckline that perfectly touches all 4 points. So we just have to consider the variations. And also, as we repeated in our very first technical analysis class, that there are no 2 exact chart patterns that look exactly the same. So patterns can help, but we have to keep in mind the variations. So we will be going over some examples of the variations that does not necessarily provide perfect head and shoulder formation. Okay, so small heads and weak shoulders. So as you can see, this does not demonstrate as clear of a head and shoulder formation as the previous ones, right? Because a very clear will be like this, will be like a mountain. So this will be a very standard pattern, right? But clearly on the screen, this is not what it shows. So if a deep correction wave followed the left shoulder before the price form a head, it may already be an indication that there is an increasing interest of selling or trend reversal, and the buyers are no longer dominant. So what we talked about before is that we have to wait for the head and shoulder all to form and for the price to go below the neckline, right? But what it's saying here is if there's already so much fluctuation before the head comes, it's a very strong indication that there might possibly be a trend reversal. So the deeper the correction waves, the bigger the fluctuation. And when the peak point of the right shoulder, which is right here, when the peak point of the right shoulder is formed far below the head, like in the scenario like this, the distance between these two is very far, right? This further confirms that the buyers are no longer at the interest. So for example, if you guys are perfectly clear, good, but I'm just gonna go over this chart again. So as you can see, there is a very uneven distribution of the right and left shoulder, right? And this shoulder is way bigger than this. And also the shoulder is way bigger than the head. But why this can be the head and shoulder is because, first of all, you see a neckline, right? Or this is what we call a horizontal support line. Also, the peak right here, this confirms the left shoulder because it's at a sideways face. And this peak curves back instead of going up, keep going up, or a straight trend down. So because we talked about this before, we talked about the doji before. This is what we call a doji, right? If we were to draw a candlestick, it will look like this. So usually this does not confirm a trend reversal, but this does, because the right shoulder is significantly lower than the head, and also because of the long fluctuation period of the left shoulder. So this can be a head and shoulder. Guys, please comment any question you have anytime, so I can stop and make sure you guys understand.
Yeah, I just want to add on something. So before, remember when we learned about candlesticks and the different shapes. For example, the doji, and we mentioned that it doesn't tell you anything by itself, but when it's with others, it is actually a very strong signal. So as Rena mentioned, when combined with these small heads and weak shoulders, it is actually a very strong indication that the market is going to go down or the sellers are taking over.
Yes, so we want to take in consideration of what we learned before of thinking about candlesticks. Oh, the first image we show actually combines a candlestick chart with a line chart. So this, right? This will be candlestick chart, while this will be a line chart. Now you can think a little bit on what are the benefits of line charts versus candlestick charts, and what are the different benefits of them. All right, so this image just illustrate the move up into the head is short and the right shoulder is barely developed, and which further indicates the trend reversal and the sell-off foreshadowed by those characteristics. Okay, so this image shows that the distance between the peak of the left shoulder, and the head is relatively small, right? And this indicates that majority of the buyers have already moved away from the market and the price can no longer raise easily. Do you guys understand that? So the left shoulder and the head, it's very, very similar distance. That means the buyers are just already gone, right? They're not even trying to push it further. They're not even trying to keep pushing it. So this, also indicates trend reversal. Yeah, so this will be head and shoulders. So as you can see, there are so many variations about this pattern. That's why we're giving so much examples so that you can recognize these patterns within stock market, stock analysis. So yeah, the last price waves toward the head is very small and hardly manages new highs. So it's not forming new highs. If we were to incorporate wave points, so this will be a high, right? High and then higher high, and then higher high. But then this will be lower high. So as you can see, the higher high actually is not increasing that much. So it's just very weak, as we learned about the degree in which the trend is at, right? So the steepness. All right, so the next component. So now that we have understanding of these different variations and different head and shoulders that may appear with the ratio of the head and shoulders, let me clear the page. We are going to move on to the next component of head and shoulders, which is the break of neckline and retest. Okay, So the break of the neckline is usually the entry signal for most traders because it completes the head and shoulder formation. Now, the break confirms that the price is at low high and the right shoulder is a first lower low as well. So the 2 points signal a change in the Dow theory. For example, what I just explained is basically right here, right? Usually, and traders will enter at this point because it's a complete formation of head and shoulders, or like right here, it's a complete formation of head and shoulders. So the stronger the break, the more impulsive the point waves that break through the neckline, and the higher the probability that it will continue the downward trend. But there is the thing that we call retest that we have to consider. It's not necessarily always just gonna keep going down. There might be retest in this scenario. So an alternative entry signal is given when the price moves back to the neckline from below. So this is very important to distinguish the difference. So everything else is above the neckline, right? But the retest is hitting the neckline again, but from below in these two scenarios. And if the trend structure remains intact and the price does not manage to move above the neckline, so if it doesn't go above this neckline, then it shows a retest or a new indication of entry point. And this retest shows that the buyers is once again tired and once again losing the competition, and the sellers have successfully defended the high and took the opportunity to bring the stock market down right here. So if it doesn't go above this point, it just indicates that the sellers again lost the battle and we're going down a downward trend. So overall downward trend. And yes, so this image demonstrates the retest of neckline reaching from the bottom. And this pattern occur frequently, but as you can see, even if we don't know if so if we enter here, right, and we don't know if there's going to be a retest, but retest often doesn't even go above your entry point, so you won't be losing any money because it go down, right? You make money while selling. So when the stock market go down, you can also make money. That's called selling. We went over it at the first class. For example, if you're selling stocks, right, you make money here and then you lose money, so you're back to $0, and then you continue to make money. So either point of these would be a great entry point, and if you enter earlier or before, there won't be much of a difference. Okay, so now that we learned about retest, we're going to cover the inverse head and shoulders. Sorry?
No, if they have any questions, because that was a lot.
Yeah.
If you guys have any questions.
Yeah, Amy was wondering if you guys have any questions. Okay. So I didn't understand well the definition of retest. Can you say that, please? Okay. So, retest is when the formation of head and shoulders right here, right, is finished, but it's the sellers are trying to push it back. The sellers are retesting. They are retesting the market, or they want to defend themselves. But ultimately, when it hits the neckline, they fail to push it back to an upward trend. So now it results in a downward trend. So what this is basically warning you about is after a head and shoulders formation, it does not necessarily indicate that the downward trend will continue to occur. There might be retests. And also, you know how the entry point is when the right shoulder goes below the neckline? But a secondary entry point is when the retest hit the neckline but doesn't go above it. That's basically a retest. It's saying that there are possible other scenarios during the head and shoulders, if that makes sense. Okay, so if you have any other questions, please stop me, but if not, I'm gonna move on. Okay, so inverse head and shoulders. Okay, perfect. So we learned about from a upward trend translating, reversing to a downward trend. But inverse basically means the same, but vice versa, from a downward trend to a upward trend. And same rules apply, right? A retest would be this. And then you go here and like that. So the neckline will be here. And this will be a retest. And then the entry point will be right here. If you want to make money, you know that it's going to go up downward trend to upward trend. Make money while buying. So the inverse head and shoulder formation is the counterpart of the regular head and shoulder formation and can be observed during a downward trend to a trend reversal to a upward trend. So the idea is basically the same as I said before. After the downward trend with lower lows, that forms the left shoulder and head. The right shoulder is the first higher low. So this is lower low, right? This is higher low. I'll just type it so you guys can take notes. This is lower low, lower low, and then higher low, higher high. This just confirms the trend reversal. And the variation, maybe can you, okay, mute yourself, please. So the variation in the retest principle is also the same as before. So if a retest were to happen here, so we will draw a neckline right here. Hold on. A neckline, so this, and then the retest will be here. So, but this doesn't have a retest. Okay, so the retest. And then this image basically is just the inverse head and shoulder formation that is observed at the end of a downward trend, which is trend reversal, and a new upward trend starts, and which at the break of the neckline. So I would argue that this will be the retest here because the neckline. I will argue that this is a retest. So I think different traders have different interpretations of head and shoulders. If they see this as a shoulder or this as a head, or this as a head or that as a shoulder. But ultimately, if you use the wave point rule to confirm the trend reversal, I think that is way more helpful than the head and shoulder formation. But if you do see a clear head and shoulder formation within the stock market, that give you a very high possibility of making money during the trend reversal. Okay. So this is, well, that was fast. So this is the end of head and shoulder formation introduction. So does anyone have any questions regarding head and shoulders? This is like one of the most important chart patterns. Because why? Because this illustrates trend reversal, right? And why do we want to recognize trend reversals? Because trend reversals, if we can identify trend reversals, we can make money. Because the point where trend reverse is a point where we enter and to make money. And head and shoulders and wave points are the things that I use to confirm when I trade in the stock market, and that have worked almost 70% of the time. So very high possibility. So you can start by practicing. You guys can go on the real market and start predicting the trend upcoming if you don't have a stock trading account yet. Well, I do believe you guys, if you have come to almost every single class and understand the course material, I do believe you guys have enough capability to start trying to predict the trends and trend reversals. And if you get good at that practicing, you can start playing around with real money.
Yeah, and this is quite similar to the candlestick patterns before, but it is very much more broad. So for example, the 3 black crows and the 3 white soldiers, those are very micro. You see as single candlestick signal, like 1, 2, 3 candlesticks. But if you see this is much broader scale, which gives you a lot of accuracy. And as you can mention, for her, it works 70% of the time, and according to statistics, it is about 81 to 83% accurate, so it is very reliable. Which is another reason why we're dedicating a whole event, a whole meeting on this one, just specifically talking about its variations and also, the secondary entry points for these common patterns.
Yeah, so hope you guys understood. If you have any questions, please ask me. So then we won't be confused moving on to future materials, because we're going to move on to much complex patterns and moving really fast in the next patterns we're going to talk about, which are these, right? The cup and handle, the ascending triangle, wedges, and double triple top.